Hey everyone, hope you guys have been enjoying our videos so far. Welcome back to the Founder Finance series from FundRaiseo. I am Abhishek, founding partner at Samvedanam Consulting, and I'll be honest with you upfront, of everything we've covered in this series, this is the one topic that quietly kills more good companies than any other. Here's why. Everyone in the startup world loves talking about fundraising. Everyone loves talking about revenue growth, about ARR, about GMV. Nobody wants to talk about the boring middle bit, the cash that gets stuck between the day you pay your supplier and the day your customer actually pays you. And that unglamorous gap, ladies and gentlemen, is exactly where profitable, fast growing startups quietly run out of money. I've sat across the table from enough founders during fundraisers, during M&A diligence, during board reviews to tell you this pattern repeats itself constantly. A founder walks into a room with a beautiful P&L, genuinely profitable on paper, and 3 months later, they're scrambling for a bridge round because they never modeled working capital. So today, we fix that. By the end of this session, you'll know exactly how to measure working capital in your own business, how to benchmark it against your sector, because good working capital looks completely different for a SaaS company versus a D2C brand versus a climate tech hardware company. What financing tools are actually available to you at your stage, including India-specific instruments like TREADS and the MSME 45-day rule that most founders have never even heard of. And finally, the 6 habits that separate cash-disciplined founders from the ones who get blindsided. Quick word of thanks to Samvedanam Consulting for hosting this series. Let's get into it. Before we get into definitions and formulas, let's talk about why this deserves your attention and why it plays out differently for you as a founder than it does for a mature listed company. There are 4 reasons this topic earns real time on your calendar. 1. It drives free cash flow directly. This is the one that catches founders off guard. You can have a genuinely profitable P&L and still miss payroll. I mean that literally, I've seen it happen. Every rupee sitting in your receivables ledger or sitting on a shelf as unsold inventory is a rupee that is not extending your runway. It doesn't matter how good your gross margin looks in the deck. 2. It signals operating quality, often before anything shows up in the income statement. When I'm screening a mandate, reviewing a company for a potential raise or a sale, the very first thing I look at before I even open the P&L is the trend line on AR, inventory, and payables. I did this recently on a B2B SaaS company that was pitching a strong ARR growth story. The receivables were growing almost twice as fast as revenue. That one chart told me more about their sales quality, discounting, weak collections process, maybe some revenue recognition aggression than 3 years of income statements would have. 3. It determines your financing capacity. When you eventually go raise venture debt or apply for a working capital line, the lender is not sizing that facility off your pitch deck. They're sizing it directly off your receivables and inventory quality. Better working capital discipline literally means a bigger line at a cheaper rate. 4. And this is the one that surprises people most. It impacts your valuation directly. In any M&A transaction or growth stage round, working capital is one of the most heavily negotiated adjustments on the term sheet. I've watched working capital adjustments move a purchase price by multiple crores in the final week of a deal purely because nobody had modeled it properly 6 months earlier. So, quick gut check before we move on. If I asked you right now, from memory, what your current DSO is, your days sales outstanding, could you answer without opening a spreadsheet? Be honest. In my experience, maybe one founder in 10 can. That's exactly the gap this session is going to close. Here's how we're going to spend our time together. The first part of the session is fundamentals, definitions, the core components of working capital, and the single most important formula in this entire deck, the cash conversion cycle. That'll take us about 15-20 minutes. Then we shift gears entirely into the founder-specific view. Why working capital behaves completely differently at an early stage startup compared to an established company. 2 very different case studies, one SaaS, one D2C e-commerce, because the mechanics genuinely run in opposite directions. And then the financing toolkit that's actually available to you at Seed and Series A, because half of what gets taught in a standard finance textbook simply isn't accessible to you yet. We're also going to spend real focused time on India-specific levers, the MSME 45-day rule under Section 43BH, TREADS invoice discounting, and GST input tax credit. I want to flag this now because these 3, in my experience, are usually the single biggest lever an Indian founder can pull to fix their cash position. and none of them show up in any American finance textbook or any Wharton case study. If you only remember one section from today, it might well be that one. We'll close with sector-specific ratios, the red flags that investors and lenders actually watch for, and a 6-item founders checklist you can literally implement in your very next Monday finance meeting. One more thing, this works best as a conversation, not a lecture. If something doesn't apply to your business or you want to go deeper on a point, drop it in the comments and I'll address it, or we'll pick it up in the next session. Now diving in. Let's start with the textbook definition and then immediately move past it, because the textbook version is not the version that will actually help you run your company. Working capital is the money a business needs to fund its day-to-day operating cycle. Not machinery, not office real estate, not your cap table. The everyday cash that pays your suppliers, funds the inventory sitting in your warehouse, and bridges the gap until your customers actually pay you. The headline formula is beautifully simple. Current assets minus current liabilities. Everything you own that will turn into cash within a year minus everything you owe that comes due within that same year. Let's make it concrete. Say your business is sitting on 20 lakh rupees combined in receivables and inventory, and you owe 12 lakh to your suppliers and staff. Your working capital is 8 lakh rupees. That's the amount of your own cash you need parked inside the operating engine just to keep it running, separate from whatever cash you're holding for growth, for OPEX, or as a safety buffer. Now, I want to flag something important here because I made this exact mistake myself early in my career advising founders. The definition I just gave you, the textbook one, includes cash and debt. In practice, almost nobody in banking, private equity, or startup finance actually uses this version. In the next section, we're going to switch to something called net working capital, which strips out the financing noise and gets you to the number that actually matters. That's the one you'll hear investors, lenders, and acquirers ask about. So let's go build that definition properly.